Hello 2024, Happy New Year! Hope you are going to be a good one and all that you desire comes true. One question though, those really bad financial outlooks, the inflation and stuff, could you please change that? It would be great if you could just shake it off. Love and thank you, pretty much every consumer or business worldwide. And of course, hello and welcome to you. Welcome to Data on Stage Presents 2024 in Finance. I'm your expert for today, Raynor the best. I am a data researcher who has been with Statista for almost 8 years, focusing especially on digital trends in finance like payments and blockchain. And thank you so much for being here today. Now, today we are talking about finance. This can be many things, ranging from personal finance to stock markets, or from sustainability to banking. Now, any of these topics could easily fill their own half-an-hour webinar. So instead, I will guide you through 3 main themes, starting off from a bird's-eye view and occasionally zooming in on specific finance aspects. Today's webinar, therefore, is for those who want to get a quick understanding on what drives financial behavior and the financial services industry in the new year. Some of these drivers come from within the finance industry. Others are connected to external factors this same industry cannot really control. And it's with these external factors I would like to start off today. Now, one of the biggest external factors from last year is, of course, inflation. Cost of living was on many people's minds in 2023. 1 year ago, several of the world's largest economies expected a recession to arrive somewhere in 2023, as inflation back then was simply that high, especially when compared to the years before or even during the coronavirus pandemic. Cue to where we're at today though, and this picture has drastically changed. Inflation has fallen from its peak. Now, while a country like Germany did get into a recession, some argue 2023 may well be the year of the recession that never arrived. The aggressive measures central banks employed to combat inflation may have worked. Now, how about 2024 then? As it stands, the latest available figures predict inflation rates for various countries are getting closer to reaching 2%. Of the 5 countries you see here, China and Japan are predicted to maybe even reach that 2% milestone somewhere this year already. Now, for those unaware, that 2% inflation rate is crucial within macroeconomics. Central banks typically aim for inflation to be below this number. Some price increases are fine, quite natural even to a properly functioning economy. But what you do not want is too much. A good example where this did get out of hand is the United States. In green, you can see the country's inflation. Now, notice it's low in May 2020 at about 0%, but then a peak of more than 9% in July 2022. That is where the monetary policies of 2023 come in. Central banks, such as the US Federal Reserve, try to pull this inflation back down towards the 2% threshold by increasing interest rates. Here you can see those rates in purple. In the past 20 months, 11 US interest rate increases were announced. Now, why am I mentioning all of this? One of 2024's big questions will be whether inflation will hit that 2% barrier and money becomes cheaper again. When and if this will happen is a significant question mark. Now, so far we have 2 external factors carrying over from last year. 1, inflation. 2, interest rates. The third external factor, geopolitics, is not entirely new either. 2023 was a year marked by multiple wars, which are still continuing as I speak. But geopolitics in 2024 is more than just that. On the one hand, 2024 will be a big election year. This map displays all the 50 countries with a national election this year. The United States has their elections in November, but do not rule out the UK or India either. This year, more than half of the global population will be able to vote, potentially changing policies all over the world. On the other hand, geopolitics is already impacting world trade. In the last month, multiple attacks occurred in the Gulf of Aden on maritime ships going through the Red Sea and the Suez Canal. 11% of all maritime trade goes through this area. And because of all these disruptions, fears are that inflation might go up again rather than down. Now, if I add these three external factors, inflation, interest rates, geopolitics, together, and you were to ask me, define 2024 in one single word, I would say uncertainty. If the last few weeks tell us anything, it is that global events still have a role to play in the new year. That's all well and good, but we are talking about people here. So now let us have a look at how individuals all over the world deal with it all now that we have the global context. Will cost of living continue to drive consumers' behavior? How would this translate into the finance industry? Or should your organization not be worried at all? Unfortunately, consumers were very much worried. A monthly survey on what issue was on consumers' minds the most illustrates this. Personal finance has not just been on people's minds, but it dominated their opinion for over 20 months in a row. 3 of the top worries are also related to each other. So, consumers being worried about money, access to money being expensive. Pretty quickly, one could think of the option to spread out payments over multiple installments with little to no interest. In English, this is called BNPL, or Buy Now Pay Later. And now for the non-English audience watching right now, you might know these payments via Klarna or Afterpay, Affirm. Although PayPal and Apple Pay are sometimes also possible. This payment option made plenty of headway since 2022 and could be called one of the main buzzwords within finance right now. Will this be bigger in 2024? You might wonder. The BNPL market is predicted to grow by over 80% between 2023 and 2026. Buy Now Pay Later could be used even more in the new year, with especially lower incomes feeling this is an easy way to pay for things. Indeed, much has been said about BNPL being used for grocery shopping. Consumer protection bureaus, however, are not sure whether this is a good thing though, as the ability of BNPL to essentially underwrite groceries with a short-term loan could perhaps add to, rather than relieve, financial pressure. Now, when we talk about financial pressure, what do we mean exactly? It can take on several forms and is difficult to judge just on a one-by-one basis. Take, for example, the US BNPL company Affirm. In the company's most recent quarter, 2.4% of its loans were overdue by at least 30 days. In other words, 2.4% of the company's clients could not pay their BNPL loans back on time within 30 days. Now let's compare this against 2 common loans, credit cards and mortgages. In the US, credit card defaulting is higher than Affirm's delinquency rate. For the UK, mortgage delinquency stands out. BNPL takes up a curious position here. Access to credit is separate and much easier. Still, it could impact the ability to pay off credit cards or mortgages. This makes personal spending rather complex going into 2024. Now, a big discussion point on BNPL is that it is not regulated yet, meaning it is not publicly tracked or reported to credit bureaus. And this may mean that BNPL is a blind spot in the financial system for consumers. More regulation to protect financial behavior from consumers will be a major theme in 2024. Now, what if we extend this a bit and include other types of loans as well? Certain apps, for example, allow consumers to take on loans outside their bank. Such apps for personal loans did become more popular in 2023. Estimates are that roughly 1.4 billion personal loan apps were downloaded all over the world. And this was about 10% higher than in the previous year. However, there were significant differences between countries. One might assume that the United States or Europe are leading in such apps, but this is not the case. Instead, India and Indonesia took up nearly half of all the downloads in personal loan apps last year. In my experience, this is because Asia did not have an established digital finance system until that long ago. In Asia, such apps essentially are the banks and have less competition than in North America or Europe. Consumers then increasingly want a personal approach to their financial situation, or at the very minimum, a quick solution to personal financial issues. This is likely connected to growing prices, but also some of the other worries we saw before. And this extends beyond loans, however, as other parts of finance services also witness this growing need for personalization. When consumers are asked what they would love to see in retail, online or in person, two things stand out. First, a fast process, speed, no friction, no hassle. In second and third place, we see personalization. Consumers would like to see a tailor-made solution just for them, be it product recommendations or a service just built specifically around them and their needs. Important to note, frictionless payments are a wish all age groups have. Baby boomers would like to see this more than Gen Z actually. But where it gets interesting is with personalization. Gen Z wants the personalized recommendations and the personalized service significantly more than older generations. Social media experiences could be the reason why here. Personalization can drive consumer loyalty and can easily be considered a main trend going into 2024. But personalization goes beyond just recommendations or a personalized service. Personalization is also about knowing consumers and being able to adapt to their needs. In that sense, it may be good to go back to frictionless payments, the innovation everyone wanted. Real-time payments or payment systems that handle payments in no time at all are already trying to meet those personalization needs. The United States and the UK, again, are not leading here though. Real-time payments here in these countries focuses on bank transactions and not so much on consumers. Because of this, India and Brazil are forecast to keep growing significantly. Brazil especially stands out because the system used here, Pix, has only arrived in November 2020, but grew so quickly that it has become commonplace for consumers in the country. Its United States counterpart, FedNow, only arrived in the summer of last year and does not yet have this consumer focus. Now, personalization is what consumers want, but how to make this happen in financial services? Enter open banking. Originally coming from the United Kingdom, open banking can become quite important. The term was first aimed at bringing transparency in the banking industry. Nowadays, it is associated with consumer data from banks being opened up for fintech solutions. In simple terms, open banking enables apps to make spending advice or automate recurring payments. Now, the value of open banking transactions worldwide is estimated to grow by more than 500% between 2023 and 2027. That said, consumers seemingly are not sure what open banking does exactly when asked about it. By and large, the speed and day-to-day practice of payments currently far outweighs other applications of open banking in a country like the UK. This is somewhat different from what we saw earlier with dedicated personal loan apps being so popular in Asia. Earlier, we already saw that Asia downloaded personal loan apps. Let us extend this a bit more and bring in another category of apps. So far, we talked about consumer income and spending. But what about consumer investments and apps that assist in that? Apps that give people budgeting tips or investment advice were again most often downloaded in India. The percentage was even higher now, making up 40% of global downloads. Indonesia, however, went down. Instead, two other countries come into view: Brazil and the United States. They are in second and third place here. Now note that downloads of personal investment apps in both of these countries is still far below that of India. Partially, this is due to certain apps like budget tracker Rocket Money not being counted. Mostly, the difference comes from the high number of downloads of dedicated stock market trading apps like Angel One in India. Now, if I can again summarize the main finance trend for consumers in 2024 in one single word, it would be personalization. As I hope to have shown you, it seeps through in several ways, either directly by way of personalized advice, but also that consumers increasingly want their specific wishes and personal financial situation to be heard. And this brings us onto the third theme for today: business. How are financial service companies approaching 2024? Financial leaders worldwide have roughly the same worries as consumers going into 2024. This year could be riskier than last year, they said in a recent survey. Like consumers, company leaders' biggest concerns are related to inflation and interest rates. This, however, gets combined with uncertainties that already existed outside of macroeconomics. That is a lot to manage. So naturally, businesses look towards technology to help them out. Now, if you were to ask me, is tech going to be important for financial services in the following 12 months? I would say undoubtedly. The question is more how important and what technology are we looking at? On the how important, well, financial service leaders say for years that tech is critical for them. The same holds true right now. 63% of executives in retail, commercial and private banking worldwide think that technology will have the biggest impact on banks in the new year, much more so than changes in consumer behavior. Now, at first glance, this doesn't seem that different. Take 2020, with 66% of banking executives saying new technology would be important. But back then, the focus was on connecting to Gen Z. Going into the new year, new technologies focuses on generative AI and machine learning. Banks focus more on current day consumer issues and replacing outdated systems. Let us pause for a second here. On the one hand, we already saw customers wanting personalization. Now we have an industry that hopes a standardized technological innovation could make this possible. And this may sound like a contradiction, but the two are actually quite closely knit together. Not only executives were eager for technology and finance, large-scale investors were too. As you might suspect, investments into fintech companies were not high last year. Global fintech funding fell to $52 billion in the first half of 2023. And it is expected that M&A activity will remain low for as long as global uncertainties remain. Two segments were not as affected, namely InsurTech and cybersecurity. This because they already have AI solutions going for them. Both Microsoft and Google announced they would use generative AI for cybersecurity, for example. Simply put, AI was a big buzzword for investors in 2023. And this is likely to go up in 2024 as more application of the technology make an appearance. Now, if AI is that much in style right now, how big will it then actually be within finance? forecasts place the total spending on AI at $400 billion in 2027. In 2023, this was $166 billion. This means AI spending overall would grow by almost 25% in the next 12 months. Now here's the same spending on AI, but just for the finance sector. Finance is to spend $97 billion on AI in 2027, almost 1/4 of all AI spending that year. Not only that, it is to grow by almost 30% in 2024, which is faster than the total industry spending. Now, what segments of finance are responsible for this? In 2023, 2/3 of AI spending in finance came from the banking industry. And this is probably because banks require heavy number processing and analytics. Language-based AI also plays a role, but not as much, as the industry only recently started looking into such applications. Indeed, finance seems to use technology mainly for processing or analytics for now. Take quantum computing, for example. Of all the use cases for quantum computing in the industry, 2 are set to take up more than half of the total market size by 2035. Corporate banking is the most likely to gain from quantum computing due to the high value of money involved. Computers with quantum computing can possibly solve extremely complex mathematical problems either simultaneously or via machine learning. And this means fraud detection is possible too. Such tech can effectively deal with numbers is of course quite valuable for an industry that relies on numbers. Going into 2024, both AI and quantum computing are very much on the minds of financial service leaders. Both are considered upgrades to legacy systems and a way to gain a competitive edge. But we may have to wait well beyond 2024 though to see the full impact of these two technologies. Now, some of you might wonder at this point, but how about blockchain technology? Especially now that Bitcoin ETFs have been approved in the United States and crypto enthusiasts argue blockchain could become more mainstream. As it stands, the market size of financial use cases in blockchain is smaller than what it was 2 years ago. Decentralized finance, as it is called, makes up about 5% of the overall cryptocurrency market. Curiously, this market doesn't seem to have changed that much. A clue may perhaps be found in a recurring survey from Canada on how people feel about cryptocurrency. Typically, Canadians saw crypto as a speculative investment. Almost 3 of 10 respondents also said in 2022 that they backed crypto specifically because of what blockchain technology could do. By 2023, this had changed. Trust in blockchain was still a motivator, but not as much anymore. Should we then entirely rule out blockchain in 2024? Not exactly. But as it stands, the finance industry spotlight seems to have shifted away from blockchain towards AI. And the theme we have not yet mentioned, sustainability. Much like blockchain, most analysts seem to agree that environment, social aspects, and overall company governance, ESG, will play a major role in 2024. This because investors are curious about it and new regulation will come in Europe. Now, what I find interesting is that regional differences can be observed here. A study from Germany noted that German investors were overall more cautious towards ESG investing than those from Spain or Italy, especially on factors like, is ESG investing actually that profitable? Or whether ESG is a factor in choosing a financial service provider. And this reservation may indicate a lack of information about this type of investment. Much like blockchain, ESG is something investors keep an eye on, but it may not be clear for everyone on how it will develop. More information on ESG will become available in the new year, potentially impacting investments and purchase decision making. Now, when it comes to finance business trends for 2024, Mostly we've been talking about technology, the full impact of which may only be felt beyond 2024. Now, as one of today's last remarks, I want to quickly go back to something from before. I spoke earlier about interest rates and whether they would go down or not. If they do go down, this is generally positive for stock markets. In investor terms, this might mean a bull market. US investors seemed cautiously optimistic a few weeks ago that this could happen in 2024. Note December 20th, for example. More than half of the surveyed stock investors in the US were bullish. And while you could argue this is typical for the end of the year, when stock markets tend to do well, the overall mood was remarkably positive. And cue last week though, because on January 17th, central banks warned investors that quick interest rate cuts, like in the past, were unlikely. And this was such a blow to stock market investors that the mood dropped immediately. Personally, I think this is quite telling for 2024 and how quickly things can change. Now, if I can summarize everything so far in 3 individual words, it would be the following. For external factors, uncertainty. Although consumers and businesses hope 2024 will relieve most of last year's problems, many question marks remain throughout the year. For consumer trends, personalization. Consumers want to see their wishes met and tailored to their specific needs and financial situation. And lastly, for business trends, technology. AI and quantum computing may meet consumers' needs and solve legacy issues in the long term, while the industry keeps an eye on blockchain and ESG. In conclusion, the finance industry has a lot going on at the moment, and this will continue going into 2024. So for everyone watching the recorded version of today's webinar, thank you so much for watching.